Private credit used to sound like one of those niche Wall Street topics that only mattered to institutional investors. Now it looks a lot more important. In this video, we break down what private credit actually is, why it exploded over the past decade, why withdrawal limits at major funds matter, and how problems in this market could spill into the real economy through tighter lending, weaker companies, layoffs, and slower growth. We'll also look at the psychology behind yield chasing, the liquidity trap hidden inside many private funds, and the big question nobody wants to answer. What happens when investors want their money back at the same time businesses are struggling to pay? If you care about money, investing, risk, and how financial systems quietly shape your life, this one matters. Subscribe for more videos on money, investing, wealth building, and financial freedom. Most people never think about where business money comes from. You think about where your money comes from, your paycheck, your savings account, maybe your brokerage account. But businesses run on money too. They borrow to hire people, they borrow to buy inventory, they borrow to expand. Sometimes they borrow just to keep the machine running for another year. And over the past decade, a huge amount of that money has been coming from a corner of finance that most regular people barely hear about: private credit. Now that phrase sounds boring, very Wall Street, this has nothing to do with me. That's usually when something gets interesting. Because when an area of finance grows quietly, avoids public scrutiny, promises attractive returns, and suddenly starts making investors nervous, it deserves attention. And that is exactly what seems to be happening. One of the biggest warning signs is when a fund built around lending starts limiting withdrawals. That's the financial equivalent of a restaurant saying, "We know you paid for dinner, but the kitchen is having a moment." Technically, it may be allowed. Structurally, it may even make sense. Psychologically, though, it changes everything. Because the second investors realize that my money is invested and my money is available are two very different things, trust starts to wobble. And once trust wobbles, markets can move from calm to fragile very quickly. So let's slow this down and talk about what private credit actually is. At the simplest level, private credit is lending done outside the traditional public bond market and outside a standard bank loan process. A company needs money. A private lender steps in. Terms get negotiated privately. The loan gets made. That part is straightforward. The reason this world got so big is also pretty straightforward. Banks changed. For decades, if a business needed financing, a bank was the obvious place to go. Then banking got more concentrated, more standardized, more scaled. Big banks love things they can repeat endlessly: mortgages, credit cards, big corporate relationships, products that fit into neat boxes. A weird mid-sized company with a complicated capital need and a messy timeline, that starts to look like extra work. So a gap opened up. And whenever there's a gap in finance, someone shows up promising efficiency. Private credit funds basically said, "We'll do the deals banks don't want to do." At first that sounded useful. Honestly, it was useful. Some businesses genuinely needed financing. Some banks genuinely had become too rigid. Some lenders genuinely were providing a service. That's how a lot of bubbles begin, by the way. With a real need, then a useful idea, then too much money chasing that idea. That's the part people always forget. The early version of an investment theme can be perfectly reasonable. The late version is where things get weird. And private credit got weird because the returns looked attractive in a world where yield was hard to find. Think about the investor mindset for a second. If treasury bills are paying very little, and somebody shows up offering 8%, 9%, maybe more through private loans, that gets attention. Pension funds notice. Institutions notice. Wealth managers notice. Even people who don't fully understand the risks start hearing the same sentence over and over. It's income. It's diversified. It's less volatile. It's private, so it doesn't move around like public markets. That last part is especially seductive, because a lot of investors confuse "doesn't trade every second" with "is safer." Those are not the same thing. If your asset doesn't get marked down every day, it can feel calmer. That doesn't mean the risk disappeared. It may just be sitting quietly in the corner, waiting for somebody to ask for cash. And this is where things start to get interesting. Private credit has a built-in tension. The loans themselves are often long-term, customized, and illiquid. The investors funding those loans may still think in much shorter timeframes. That mismatch matters. Imagine a fund has billions tied up in loans to dozens or hundreds of businesses. On paper, everything looks fine. Interest is flowing. Valuations are stable. The quarterly update looks polished. Then something shifts. Maybe rates stay high longer than expected. Maybe defaults tick up. Maybe private equity exits slow down. Maybe investors just get nervous and want more cash on hand. Now, the fund faces a problem. Its assets are not like Apple stock. It can't just press a button and sell a giant pile of customized loans at full value by tomorrow afternoon. So if too many investors want out at once, the manager has to choose between selling assets into a weak market or slowing redemptions. Neither option feels good. One hurts performance. The other hurts confidence. And confidence is doing a lot of the heavy lifting in markets like this. Now, let's zoom out, because private credit did not become a multi-trillion-dollar story by accident. One big reason is private equity. Private equity and private credit are like two people who keep telling each other, "This is fine," while the room is getting warmer. Private equity firms buy companies, often using borrowed money. Those companies may then carry debt of their own. The fund structure itself can involve layers of financing. The whole ecosystem becomes extremely dependent on credit staying available. When money is cheap and exits are easy, this machine looks brilliant. You buy a company, you optimize it, you refinance it, you sell it later at a higher multiple. Everybody celebrates the internal rate of return. But the real issue shows up when time passes and the easy exits don't arrive. Now, the debt is still there. The refinancing need is still there. The company still needs to perform. And the lender suddenly cares a lot more about reality. Here's a simple contrast. Two companies each generate $20 million in annual operating earnings. Company A has very little debt. Its interest cost is $2 million a year. Company B got loaded up with floating rate debt during the cheap money era. Its interest cost was $3 million a year when rates were low. Then rates rise. Now Company B's interest cost jumps to $7 million. Same business, same customers, same industry. Completely different level of fragility. That extra $4 million has to come from somewhere. Usually it comes from one of four places: higher prices, lower payroll, reduced investment, or weaker margins. And if the company can't raise prices because customers are already stretched, then it starts cutting internally. Fewer hires, slower expansion, delayed projects, layoffs. This is why private credit matters outside finance. These loans are tied to actual companies doing actual things. This isn't only a story about rich investors getting slightly lower returns than they expected. This is also about whether businesses can keep funding operations at a cost that makes sense. And here's the mistake that quietly changes everything. People often look at high interest rates and assume lenders are winning. Sometimes they are, until borrowers start breaking. A loan paying 10% sounds great right up until the borrower can't make the payments. Then your 10% income stream becomes a workout process, a restructuring, a forced extension, or a loss. There's a point where charging more doesn't improve the loan. It just increases the odds that the borrower eventually snaps. That's the hidden trap in floating rate lending during a tightening cycle. At first, higher rates make the yield story look attractive. Then the stress shows up with a delay. And delayed pain is dangerous because it encourages denial. For a while, everyone can tell themselves the system is holding up. Payments are still coming in. Defaults are manageable. The quarter wasn't amazing, but it was okay. Then suddenly, the isolated cases start forming a pattern. One troubled borrower, then a few more, then a fund gates withdrawals. Then another manager starts talking more carefully on earnings calls. Then analysts start using phrases like selective pressure and pockets of weakness, which is finance language for, we are absolutely watching something ugly develop. Midway through all of this, a lot of regular investors miss the biggest psychological shift. The story changes from return chasing to liquidity preference. That sounds technical, but it's actually very human. When times feel good, people ask, how much can I earn? When times feel uncertain, people ask, how quickly can I get my money back? That second question can break structures that looked perfectly healthy under the first question. Here's a simple example. Say you invest in a vehicle targeting 9% annual returns. You're told the loans are diversified. The income is attractive. Volatility appears low. Then treasury yields sit around 4% or 5%. Suddenly the spread between safe enough and complicated and illiquid doesn't look so compelling. You start wondering whether an extra few percentage points are worth the lockup risk, the opacity, and the chance that the marks are smoother than reality. That is when investor behavior changes. And finance is full of structures that work beautifully until behavior changes. Housing did that. Venture did that. SPACs did that. Commercial real estate is learning that lesson too. Private credit could be another version of the same movie. Different asset, same human pattern. Easy money creates demand. Demand pulls in supply. Supply expands standards. Returns compress. Risk gets disguised by growth. Then the environment changes. And this is the part most people never think about. Opacity can make a market feel safer right until it makes it scarier. In public markets, ugly information gets priced quickly. It's unpleasant but visible. In private markets, stress can stay hidden for longer. Valuations move slower. Deals are negotiated behind closed doors. Investors get less frequent updates. The story stays cleaner than the underlying reality. That can delay panic. It can also intensify it once confidence finally cracks. Because when people don't really know what something is worth, they start assuming it's worth less. Now let's do a little math, because math has a way of cutting through elegant marketing. Imagine a mid-sized company borrowed $100 million at a floating rate. At 5%, annual interest is $5 million. At 9%, annual interest is $9 million. That's a $4 million difference every single year. Over 5 years, that's $20 million in extra interest expense. For some companies, that is the difference between growing and stalling. For others, that is the difference between surviving and defaulting. Now imagine a private equity-owned company with multiple layers of debt and an owner expecting strong returns on top of that. The company isn't only trying to operate well, it's trying to satisfy a capital structure designed during a very different financial environment. That's a problem. And it gets bigger when you remember that plenty of these businesses are not tech giants with huge margins. They're ordinary operating companies, healthcare services, industrial firms, consumer businesses, regional providers, boring companies with real payrolls. If funding gets tighter, the consequences spread outward. Less hiring, lower capex, more restructurings, more cost cutting. That turns a financial story into an economic story. And when enough economic stories pile up, they circle back into finance. Because weaker employment means weaker consumer spending. Weaker spending hurts business revenue. Weaker revenue hurts debt service. Hurting debt service creates more problems for lenders. That's the feedback loop. And feedback loops are where manageable issues become systemic issues. Now, does this mean private credit automatically becomes the next 2008? No. That comparison gets thrown around too casually. The banking system is different. Capital rules are different. The structure of the economy is different. But dismissing the risks entirely would be its own kind of laziness. Because here's what matters. A market can be smaller than 2008 housing and still create serious pain. A market can be contained and still cause layoffs, bankruptcies, losses, frozen deal flow, and tighter credit conditions. A crisis does not need to end civilization to matter. Sometimes it just quietly lowers growth, destroys a lot of paper wealth, and makes life more expensive and less flexible for everyone downstream. That is already enough. There's another angle here that deserves attention. Private credit boomed during a period when investors got trained to believe that yield could always be engineered. If one product got crowded, finance created another. If public bonds paid too little, private funds offered more. If risk looked high, someone added a structure, a wrapper, a tranche, or a reassuring slide deck. Eventually, a whole generation of capital allocators starts believing that complexity itself is a source of return. Sometimes it is. Sometimes complexity is just a place risk goes to hide. And when that hidden risk starts to surface, people realize they were never being paid for certainty. They were being paid for discomfort. They just didn't feel the discomfort yet. That distinction matters for regular viewers too. Because even if you never touch private credit directly, the lesson shows up everywhere in personal finance. Whenever an investment promises better returns without obvious trade-offs, stop and ask a very annoying question. What am I giving up? Liquidity? Transparency? Simplicity? Control? Downside protection? There is always a trade, always. That applies to private funds, it applies to real estate syndications, it applies to structured products, it applies to private REITs, it applies to plenty of investments marketed as stable and sophisticated. You do not get extra return for free. You usually get it by accepting one of three things: more volatility, less liquidity, or more credit risk, sometimes all three. And once you understand that, a lot of financial marketing becomes much easier to translate. Now let's bring this back to the bigger picture. What would a real deterioration in private credit look like over the next few years? Probably not one dramatic morning where everyone wakes up to chaos. More likely it would look slow at first. More lenders getting selective. More refinancing getting harder. More companies quietly missing targets. More lenders extending and pretending. More investors discovering their capital is far less flexible than they assumed. Then, at some point, the slow stuff starts showing up in faster data. Higher defaults, more distressed exchanges, lower fundraising, fewer exits, wider spreads, more layoffs in leverage sectors. And once enough people see the same pattern, the market can shift quickly. Because in finance, sentiment changes gradually, then all at once. There's also a political issue in the background. If a market becomes large enough and interconnected enough, people start whispering the same uncomfortable phrase: too important to fail. That's always where things get ironic. Private markets often market themselves as smarter, more disciplined, more exclusive, more sophisticated than the public system. Then when losses show up, suddenly everyone remembers that the broader economy might be affected. Funny how that works. And to be fair, governments do face ugly choices in moments like that. Let the losses hit and risk wider fallout. Step in and support liquidity and risk teaching markets the exact wrong lesson again. Neither option is clean. Which is why the better question is earlier in the process. Why do we always wait until a structure becomes essential before we admit it might be fragile? That question applies far beyond private credit. It applies to banks, to housing, to commercial real estate, to consumer debt, to retirement systems. We tend to notice fragility only after years of calling it innovation. So what should regular people take away from all of this? First, pay attention to liquidity. In your own financial life, liquidity is underrated until the moment it becomes the only thing that matters. Emergency funds feel boring until your income changes. Cash feels inefficient until opportunity shows up. Simple balance sheets look unexciting until a stressed market starts punishing everyone who got too clever. Second, be skeptical of smooth returns. Sometimes smoothness comes from quality. Sometimes it comes from stale pricing and limited visibility. Those are very different things. Third, remember that leverage amplifies both intelligence and stupidity. It can improve good outcomes. It can also make ordinary mistakes fatal. And fourth, understand that financial stress usually spreads through everyday channels, through hiring freezes, through tighter credit, through weaker small and mid-sized businesses, through reduced investment, through lower flexibility for people who are already stretched. That's why even very technical credit stories matter, because eventually they stop being technical. They become human. A business owner can't refinance, a company cuts staff, an expansion gets canceled, a town loses jobs, a household falls behind, a retirement fund marks down assets, a lender pulls back further. That's the real chain reaction. So yes, private credit might still muddle through. Some funds will manage risk well. Some lenders will come out stronger. Some fears will prove exaggerated. That happens too. But when a market grows this quickly, depends this heavily on confidence, and sits this close to the real economy, it deserves more than a shrug. It deserves scrutiny. Because the most dangerous financial problems are rarely the ones everyone is screaming about. They're the ones hiding in plain sight while the pitch deck still looks calm. If you enjoyed this and want more videos that break down money, investing, risk, and the patterns that quietly shape financial freedom, subscribe to the channel and watch the next one.